In this video, I'm going to do fundamentals of partnership. What is a partnership? Partnership is a business which is carried on by two or more persons. The persons who have agreed to do partnership business is termed as partners, and they are collectively known as firms. They are collectively known as firm. So this partnership business is managed by all the partners or any one of them acting for all. The partners agree to share profits of the business in some ratios. And the partnership business comes into existence by an agreement. These are the important element of partnership business, that the business is managed by all of them or it may be managed by one of them acting for all. Another important thing that you need to have in the partnership is the agreement to share the profits of the business. The partners agree to share profits in some ratio. And thirdly is there should be an agreement to start a business. Now, this agreement can be the oral agreement or this agreement can be in writing. Now, agreement as to what? This agreement will have or will include terms and conditions of managing the business. This agreement will also gives the rights and duties of partners. So the agreement can be oral or the agreement can be in writing. The written agreement is known as partnership deed. So you can have partnership deed. So the written agreement among the partners is known as partnership deed. So this partnership deed will contain rights and duties of partners and also the terms and conditions of managing the business. Now when we talk about the terms and conditions, what could be the terms and conditions? Like how much of capital should be brought by the partners, how the profit should be distributed among the partners, what should be the rate of interest on the capital brought by the partners, and so on. The objective of the partnership business is to earn profit and share this profit. Profit is earned and the profit is shared. Profit will be shared among whom? Will be shared among the partners. So the profit is shared by partners in some ratio. Profit needs to be calculated before sharing. Profit is calculated by preparing profit and loss account. So to find out the profit and loss account is prepared, and you know the profit and loss account is prepared this way. This is your debit and this is your credit. This side you write all the expenses and this side you have the income, and the remaining amount is here the net profit of the business. Now this net profit of the business will be distributed among the partners. Now in order to distribute net profit among the partners, a new statement is prepared which is known as profit and loss appropriation account. So profit and loss appropriation account is prepared after the profit and loss account. Now why is profit and loss account prepared? Profit and loss account is prepared to find out the net profit, and this net profit is distributed among the partners. Now how this net profit is going to be distributed will be shown in another account known as profit and loss appropriation account. So profit and loss appropriation account is prepared to show distribution of profits among the partners. Profit can be distributed among the partners in the form of interest on capital. In the form of interest on capital. Salary to partners. Commission to partners. Okay, all these are distributed or given to the partners out of profit. Here we'll write down it is given out of profits, or net profit will be written on the credit side. So you have a net profit here. If the interest on capital is allowed, then the firm may decide to charge interest on drawings. And when a firm charges interest on drawings, the firms will receive the interest from the partners. Mind it, the firm will receive. So this is going to be the income of the firm. So income of the firm is on the credit side. So here on the credit side you have interest on drawings. Out of these two, interest on capital, salary to partners and commission to partners, and whatever other things are there given to the partners will be given out. Anything to be given to the partners from the profit will be shown here, and that the remaining amount, that means this, the total of this minus this, is the balance profit or the remaining profit, which will be distributed to the partners, it will be distributed to the partners in some agreed ratio. So this is the profit that is going to be distributed among the partners. Supposing if there are two partners A and B, then this profit, say the profit comes to 5,000. After subtracting, you have the balancing amount 5,000. Then this 5,000 will be distributed among the partners A and B in some ratio. Supposing the ratio agreed by them is say 3:2. This is the ratio of profit sharing. So this profit will be shared in the ratio of 3:2. 3:2 means the A will get 3 share out of the total 5. B will get 2 share out of the 5. So A's share will be, A will get 3 share out of the total. 3 plus 2 is 5. So out of the total. So here distributing fraction becomes 3 by 5 into 5,000. So it is 3,000. So here A will get 3,000. Similarly for B, B's is 2 by 5. So 2 by 5 into the total profit, that is 5,000, will give you 2,000. So this 2,000 will be shared by B. So this the statement which shows how this profit is distributed among the partners is known as profit and loss appropriation account. Now the very important point. Now here you have said how this profit is distributed among the partners. It is distributed in the form of interest on capital, salary, commission, remaining profit in certain ratio. And if there is drawings, there should be interest on drawings should be charged. Now if there is interest on capital, now what rate of interest should be paid? If there is a salary, what amount of salary should be paid to the partners? If there is a commission, how much of commission should be paid to the partners? How is this determined? All these are determined by what? By a partnership deed. Determined by the partnership deed. That means all these interest on capital, salary, commission, interest on drawing, all this should be calculated as per the agreement you have, or as per the clauses mentioned in the partnership deed. Now the important question is, if there is no partnership deed, you can have oral agreement, there is no partnership deed. So a partnership business can be established without having a partnership deed. That means having oral agreement. But in future, it's going to be danger. There may be some disputes, and these disputes have to be settled. If there is partnership agreement, well and good, it will avoid the future disputes. But if there is no written agreement or partnership deed, then the firm is going to follow the provisions in Partnership Act 1932. If there is no partnership deed, if there is no written agreement, then all the future disputes will be settled by following the different clauses or provisions mentioned in the Partnership Act 1932. In absence of partnership deed, these are the clauses that you got to follow. No interest on capital. No interest on capital. That means interest on capital will not be paid. No interest on drawings. Again, interest on drawings will not be charged. No salary or commission paid to the partners. Interest on loans advanced by partners. Interest on loan given by partners to the firm will be calculated at the rate of 6% per annum. And number 5, profits should be distributed equally. In absence of partnership deed, that means if there is no agreement among the partners, then the partners will not get any interest on his capital. The partners need not pay interest on drawings because interest on drawings cannot be charged. Partners will not be paid salary, neither the commission. Interest on loan given by the partners to the firm paid at the rate of 6% per annum. And very most important part is profit will be distributed equally among the partners because there is no profit sharing ratio agreed upon. These 5 important points you have to keep in mind while preparing profit and loss appropriation account.